Hey, I'm Matt Caruso. In this video, we're going to take a look at how you can easily and effectively identify bull and bear markets. We're then going to take a look at a simple tool you can use in TradingView so you can always keep a pulse on what the market's really doing. Lastly, we're going to take a look at how I've used these tools over the past couple of years to pivot through these markets and what's coming up now in 2023. So first off, what's a bull or bear market? So several decades ago, some of the most popular technical analysts realized that when talking to clients, they had to have somewhat of a definition of what a bull or bear market is. So the common definition that people use is that a drop of 20% or more in the indexes is a bear market, and an advance of 20% or more in the indexes is a bull market. Anything between 5 and 20% is typically called a correction. However, this is really not helpful whatsoever. If you're waiting for a 20% drop to think that, oh, I'm in a bear market, I need to do something now, it's way too late. In fact, most bear markets on the S&P 500 historically have not been much worse than 20% drops. So kind of waiting for that signal that we're in a bear or a bull market is pretty much useless. But going beyond that, before we look at what are the right tools, you have to also identify what are the markets that you're paying attention to. I mean, people talk about the stock market as if it's a unified thing, and sometimes that's the case. But oftentimes, it's like the saying goes, it's not a stock market, it's a market of stocks. Taking a look just at 2022 in the different indexes, well, the Dow Jones fell 22% from its peak in 21, but finished the year of 2022 only down 8.7%. The S&P was down as much as 27% from its all-time high, but finished 2022 down only 20% for the year. And last place was the NASDAQ 100, dropping about 38% from its all-time high in November of 21 to the lows of 2022. It gets worse than that. If you're in some of the more actively traded stocks, if you're in some of the popular ETFs of the COVID bull market, such as the ARK Innovation, ARKK, well, ARK, by the lows of 2022, was down 82% from its peak of February 21. And a stock that we all know and love, or at least a product that we all love, is Zoom Communications, where that peaked as well, was a big benefactor of the COVID lockdown situation, but at the lows of the 22 bear market, it was down 89% from its peak. So these are vastly different returns, depending on what sector, what industries, what indexes you're looking at. So the reality is, trying to figure out a bull or bear market is not really contained just to one index. It depends what you're looking at, and you need some tools to tell you what's going on beneath the surface. Because just looking at the Dow can give you one impression, or just looking at the NASDAQ can give you a completely different impression. So the first tool I want to talk about is the net highs and net lows tool. This is a very simple concept. Basically, each day we take a look at the number of stocks making 52-week highs, we subtract the number of stocks making 52-week lows, and we get a net number. So for example, if today 100 stocks make new 52-week highs and 20 stocks make new 52-week lows, we have 80 net highs. On the other side of the coin, like we saw a lot in 2022, if we have 80 new lows and only 10 new highs, we have a net 70 new lows. This is very important, looking at the highs, the 52-week highs and lows, because obviously stocks have a lot of volatility day to day. And you can't get as much information. It's not as much of a critical factor if a stock is just up or down several percentage points. However, if a stock is trading at a new 52-week high, that really means there's a lot of conviction in buyers. They're willing to pay a higher price today than they have for the entire past year. Similarly, if a stock is making 52-week lows, this is an investor that's looking to sell a stock with a certain amount of intensity. They want out of the stock. They're willing to pay new 52-week lows to get out of their stock. So 52-week highs and lows are a critical data point and unique and very different from just a regular high, lower close of any specific trading day. Therefore, when you see net highs, in general, you have more stocks breaking to new 52-week highs, and that means there's a lot of conviction in buyers. This is very important because if you take a look back at different bull markets throughout history, if you look at the post-financial crisis bull market, you can look at the 2013 rally, 2016, 2018, of course, the 2020 to 21 bull market, all substantial bull markets and trends happen with net highs day after day on a continuous basis. Yes, there's always going to be some stocks that are weak, but on balance, there are more stocks making 52-week highs than 52-week lows. Similarly, any bear market or any significant drop will be seen with net 52-week lows. More stocks breaking down. There'll always be a couple of stocks that can float to the surface, but in general, more stocks are being sold and sold aggressively. If you can just stick to this simple concept, it'll be virtually impossible to be caught off guard by substantial bull markets and not being invested, or being caught off guard by big bear markets and losing your hard-earned capital. Now, legendary investor William O'Neill has done a ton of great research. If you've never read his book, How to Make Money in Stocks, I highly recommend it. He says in that book that through his research, he found that 75% of stocks move with the general market. So if most stocks are making 52-week highs or on a net basis, you need to be more of a buyer than you are of a seller, and vice versa. If more stocks are breaking to 52-week lows, you need to be very conservative, cautious, and look to raise capital and possibly exit. Now, is this a perfect indicator? No such thing exists. One issue with the net highs, net lows, there can be some false starts. There could be choppy markets where you can get a few days of net highs, then we push back to net lows. I really use this as a guide personally, not as a black and white, I need to be fully invested or fully in cash. However, if I see net highs developing in the market, I need to force myself, edge myself to find some quality stocks with quality setups where I can buy them with a low risk setup. Following this approach, if we develop into a more sustained uptrend, I will always have adequate exposure that I can build on as that trend persists. However, of course, the pro is you'll never get caught off by any significant trends, which is so important. One way I like to balance the pros and cons, and especially the con by the fact that sometimes you can have some false signals, is I always like to have a backup for my tools. Another way of looking at the data that can perhaps shed more light or highlight more significant signals that maybe a day-to-day type signal like the net highs, net lows tool won't notice. So another tool I like to look at is the advanced decline line. So this is kind of similar in nature to the net highs and net lows in that you're looking at the components of the market. What are the stocks doing within the market itself rather than the general index? I mean, these all fall under the category in technical analysis of called breadth indicators, where you're looking at the components rather than the top level. Now, the advanced decline line each day takes a tally of the number of stocks advancing and the number of stocks declining and adds that net number and builds this line. You would expect in bull markets, as the index is advanced, that you would see day to day more stocks advancing than declining. That absolutely makes sense. However, at key turning points, that's not the case. For example, in late 2021, you saw the NASDAQ making new all-time highs kind of week after week. However, the advanced decline line was no longer making new all-time highs in the fall of 2021. So how can that be? How can the indexes be making new all-time highs and the majority of stocks are no longer participating to the upside? Well, when you understand how the market really functions, you have to put yourselves in the shoes of the people and the organizations that are really moving the vast amount of stocks. Institutions, that's pension funds, mutual funds, sovereign wealth funds. These are the people that have a lot of stock they have to move, and they can't just buy and sell one stock at a time when they want to get in or get out. It takes days, weeks, months to establish a position or to exit a position. Now, most of these investors also have a mandate that they need to stay invested in the stock market. They can't go to cash like most typical retail investors or even some hedge funds can do. They have to stay invested in the market. So put yourselves in the shoes of a very large institutional investor who has a negative view of what's coming next for the next 6 months, 9 months, 1 year. Put yourself in the shoes of an institutional investor in the fall of 2021. Well, you don't want to be holding small and mid-cap stocks. You want to have very large stocks, stocks like Apple, Microsoft, Caterpillar, McDonald's, where they have proven business models, where they have pricing power, where they have well-run management, where they have access to capital. So you're going to want to rotate out of all of your small and mid-cap stocks and increase your exposure to these large and mega-cap stocks. Now, as these very large cap stocks continue to go up, as all of this buying comes in, I mean, they can soak up a lot of capital because they have such large market caps, while these institutions turn around and start to liquidate all of their small and mid-cap stocks to feed that capital into the large caps. So you end up having many stocks declining and only a few large cap stocks still advancing. And that's why you get these divergences in the advanced decline line. Same thing happens at market bottoms as these funds start to now feel that there's a bright future coming around the corner, while they start to liquidate all of their large cap stocks that have less upside. I mean, they're more established companies. They're not going to grow substantially if things improve. And they start to rotate some of that capital into mid, small cap stocks that have better growth prospects. And that's why typically at a bear market bottom, you'll see the indexes still making new lows, but the majority of stocks are no longer participating to the downside. This is very important, and this helps to identify more important turning points. So for example, late 2021 and what we're looking at now potentially as we enter into 2023. We'll get to that in a moment. Before we get to there, I want to show you how you can add these tools in TradingView. So TradingView is a great charting application. They have a free tier for people to use, which is why I always recommend people test it out because they don't have to kind of subscribe to it. If you go over to tradingview.com and you look into the indicators section, if you type in Caruso Insights, you'll see an indicator come up called US Markets Net Highs, Net Lows. And that's a tool that I use on my charts where I can see the net highs and lows each day in the market. You can specify if you want to have only the NASDAQ you want to look at or just the NYSE or all of them together. I typically prefer the NASDAQ because that's where I like to put my attention. So it's a very helpful tool. I always keep that under my charts, and it's really difficult to get caught off guard by major trends just by having this simple tool beneath your charts. So how did these tools help me navigate the past couple of years? Well, in late 2021, it started to become apparent to me with the advanced decline line showing a divergence. And as the markets made new all-time highs, we actually had 3 days in a row of net lows beneath the surface. So you're at all-time highs for the indexes on the NASDAQ, yet you have more stocks making 52-week lows. That, to me, that was a major warning sign. I tweet often on Twitter. My handle is at @trader_mcaruso. You can see I put my tweet overlaid on this chart. The nice thing about TradingView is you can kind of just copy and paste the link and it'll post it specifically on the day that the tweet was made. And you can see right at all-time highs, I already had the caution flag up notifying me that, hey, there's a lot of trouble underneath the surface here. And I was able to avoid the big bear market of 2022. Similarly now, as we are, what I feel, putting in a bottom, I recently had a YouTube video. You can see the link below where I mentioned why I think we've bottomed back in October. You can see a lot of these same market internals have now shifted. We're only a few days off the bear market lows for the NASDAQ, yet we have net highs for several days in a row. As well, if you look at the NASDAQ composite on a closing basis, just looking at the closing values, in December, we made new closing lows for the bear market lower than October. However, the advanced decline line did not make lower lows in December. So what will come next? I'm not quite sure, but these tools have definitely helped me navigate this bear market, and they have allowed me to start beginning to position myself bullishly here as we begin 2023. So what comes next? Things can change. We're very dependent on data and inflation. I personally have a bullish outlook. However, trying to step beyond opinion and focusing on data, which is what I do to actually determine what are my optimal portfolio exposure levels. Should I be buying? Should I be selling? Those two main tools that I use, the net highs, net lows, and advanced decline line, are now showing us that we have a better market underneath the surface and we actually have strength developing. If you like this video and you want to see more of these, please like, subscribe. In the comment section, let me know if there's any other topics you want to talk about. I've been a professional trader for, since 2008. I've been trading since 2003. I love to teach. I'm also a former finance professor. I love to connect with people. I wish I would have had someone I could ask all these questions to, a professional investor. Now through social media, YouTube, it's more possible than ever before. So if there's anything you want me to discuss, please put it in the comment section. And I hope to make some more of these videos in the near future. Thank you.